institution that has weathered the Second World War, the partition of India.
Long years ago, we made a tryst with destiny, and now the time comes when we shall redeem our pledge.
A full-blown balance of payment problem, and more recently, the worst global financial crisis in 70 years. As a banking regulator, it serves the myriad financing needs of a fast-growing economy. While as a monetary authority, it protects the poor and the middle class from the scourge of inflation. An institution that pumps lifeblood of liquidity into the Indian financial sector, and it keeps running like a well-oiled machine, not too fast and not too slow. None of these tasks are easy. One misstep can lead to a debilitating crisis. If we in India have avoided falling into a financial black hole, the credit must go to the Reserve Bank of India and the 22 men who have headed the apex institution at different times over the past 75 years. The men who've collectively shaped the age of prudence.
There were no precedents to go by, no foreign examples to emulate. The Reserve Bank had the problems of India were sui generis, and the Reserve Bank had to try to fashion its policies and devise policy instruments to meet the needs of a developing economy.
RBI has saved the country many times, but the most important one is the latest occasion on which the RBI has stood between the country and financial regress.
It was a terrible time. Giants of Wall Street crumbled like sandcastles. Others teetered on the verge of extinction. The crisis, which had its origins in a gigantic housing boom-bust, brought back fears of the Great Depression. Global trade froze up. Economies around the world went into a deep funk. India, though, emerged relatively unhurt. Sure, factory production and exports slumped, but the banking system was resilient, and that kept panic at bay. The credit for keeping the Indian financial system safe goes to Governor Y.V. Reddy, or Aunty Greenspan, as he was called in some circles for his hawkish stance on asset bubbles.
Those who called him conservative then are saying, oh, good, India was not affected by the financial crisis.
Reddy was cautious on capital flows, kept a close vigil on the banking system's vulnerabilities, and delayed introduction of the type of derivative products that brought down the Western financial system. In the end, Reddy stood vindicated.
I felt strongly that we have to take precautionary measures. In a way, I felt somewhat cornered sometimes with some criticism. But I found by and large there was an element of understanding, and government also, while there have been always discussions, at the end of the day, the policy space was provided to me by the government, and that's something which we should concede. So this is the credit for success of managing the financial sector with stability, while aiding growth, unprecedented growth, and maintaining price stability during the last 5 to 6 years, should be really shared between the government and the Reserve Bank.
This was not the first crisis that former Governor Y.V. Reddy encountered in his 5 years in office. A year into the job, Reddy had to deal with the failure of Global Trust Bank, a much-hyped new-age private bank, where things had gone horribly wrong. By 2004, it became apparent that GTB had a negative net worth on account of overexposure to the capital market and mounting bad loans. The bank's reckless lending practices came out in the open, and it saw a run on its deposits. It was time for swift, decisive action, with the central bank and the government acting in perfect coordination. That's just the combination Reddy pulled off. the RBI imposed a 3-month moratorium on deposit withdrawals to halt the run on the bank. Very soon, GTB was forced to merge with state-run Oriental Bank of Commerce. Many of the tactics Reddy used to deal with the bank failure were roundly criticized, but the same techniques became very popular with Western regulators when the global financial crisis hit 4 years later.
I think that's extremely interesting case, and it will be very useful for the RBI to prepare a case study of that bank, because that was not, in a way, it was not a very large bank. Nowadays there is a debate, too large to fail. It's not necessary that something should be too large to fail. Something systemically important is also important. GTB had presence in critical sectors, that's one. Whatever the decision we had to take, it had to be quick, sudden, and well worked out, with full cooperation from the government and the banking industry. The lesson was more for the banking system than for RBI. The banking system got the lesson that if you are weak, you will not be allowed to survive. However powerful, however important. And that really went home. So I would say there are a lot more lessons to the banking industry, and after the next 3 to 4 years we were able to completely clean up the banking system. Mergers, acquisitions, closures, etc. From the Reserve Bank of India point of view, in some ways when I look back, we find many things that we did and which were criticized, that exactly what was done after the crisis. Whether operating over the weekend was criticized, why did you do the weekend? But most of the actions now you know, the banks are over the weekend. But our law also was facilitating. For instance, in UK they had a problem. The law did not permit the type of mergers that we could do almost forcibly. But it is an extremely important lesson for the future also, in terms of, I would say, lesson for the new regulatory framework that is under consideration in other countries.
From what could be easily controlled to what could not. In the past few decades, RBI has managed it all. Take, for instance, the Asian currency crisis of 1997. Ex-Governor Bimal Jalan, who was appointed when the crisis was at its peak, recounts the enormity of the challenge.
It was the most difficult day of my entire executive career. The period within which the Asian crisis took place was no more than 15 days. We took anticipatory action at that time to float 2 bonds, which were highly successful, NRI bonds, the India Resurgent Bond and also a development bond. So it increased our capacity to handle any fluctuations or any speculative attacks on the rupee. They became worse and worse for about a year, after the Asian crisis, because our external position was not that strong, as you know. We were not in difficulty, but I think it was 20 billion or something by way of reserves. And there was tremendous amount of speculative pressure on the rupee. And so you would have seen rupees would have declined by, say, 10%, 6%, 7% during the course of the day. So how to manage that problem was probably the most difficult one. And it was that everybody wanted to get out of the rupee, get into dollars. Even if you were, say, an exporter, you would have done well to keep, if this was a feeling, speculative feeling, to keep your dollars abroad and then encash them when the rupee had depreciated. So it was a very difficult period.
Which brings us to what was possibly the biggest challenge that the Indian economy has faced in the past few decades: the balance of payment crisis of 1991, when the country had to pledge its gold reserves, a very tough decision in a country that has for a long time placed its trust in the safety of the yellow metal.
We had a debt default problem. That is, we had borrowed money from the New York interbank market on behalf of the State Bank of India to purchase crude oil and other essential commodities in the 80s, and that we could not repay because of balance of payment problem. At that time we had also approached the IMF, and the IMF had agreed to a loan, but at the same time they thought that we should apply our own gold reserves to the solution of our problem. This was one of my major challenges, and I think we were able to persuade the government to agree to the gold movement, and we pledged the gold with the Bank of England and the Bank of Japan, and raised money to be able to pay off the debt, the immediate installment. I think that was a traumatic decision, a decision which forced the people to realize that we were in a crisis and that reforms needed to be made. I had further problems because during that time the Harshad Mehta scam took place, and I think I had to face the JPC inquiry because I had chased the Harshad Mehta and identified the problem, and it was considered that the policeman who chased a thief was responsible for the thief's action. And I think the Joint Parliamentary Committee spent a year and a half discussing various hypotheses. And I think my most memorable point was my defense of the RBI's role in the transaction and the support that I got from Dr. Manmohan Singh, who believed that RBI had its integrity intact and that I had done my bit to safeguard the situation, and that I had no part in concealing any part of this transaction. I think that the Harshad Mehta incident also enabled us to look at the payment system and enabled us to institute banking sector reforms.
In many ways, the 90s changed the landscape of Indian banking forever. Over the decade, two committees, headed by former RBI Governor S. Narasimhan, scripted the reform agenda for Indian banks.
What our 91 committee did was try to free the banking system from this nitpicking regulation, give regulation a more purposive character, make it much more effective, and not go into where you open a branch or how many people you have in a branch, but concentrate on aspects which would improve the productivity, the efficiency, and in the ultimate analysis, the profitability of banks. So asking banks to follow, have adequate capital, and one of the main recommendations of the 91 committee was to enhance capital ratios, to make capital in relation, enhance capital in relation to risk assets, and secondly, to follow a system of prudential norms for provisioning and risk management and project appraisal. And at the same time, we try to bring about internationally recognized system of accounting in banks, income recognition, which was absent before that. In fact, concept of non-performing assets, one might say, derives from the report of 91, where we classified in assets and said that those that didn't satisfy certain repayment norms should be declared non-performing. And so paying attention to the quality of banking and quality of banking assets without intrusive regulation, having purposive but effective regulation rather than intrusive administrative control of the banks. That was the philosophy of 91, which also pervaded the 1998 recommendations. The point was that the ownership of banks was not the issue. Flexible, operational flexibility and functional autonomy were what was required for the banking system.
The changes that were unleashed in the 1990s were a direct response to the excesses of state-directed socialism and the license permit Raj system of crony capitalism practiced in the previous 3 decades.
What should have been entrepreneurial decisions were really made by the government. What to produce, where to produce, how to produce, at what price to sell, whom to sell. All these functions were taken by government rather than by the entrepreneurs. we were stifling enterprise and not allowing our economy to grow to its full potential. I'm talking about the 50s, 60s and even into the 70s, when our growth rate was a dismal 3.5%, and with the population growth at around 2%, the per capita income growth was less than 1.5% per year, which was totally inadequate given the needs. And our growth was not up to our potential or what the needs dictated. So we needed to break out of this strict regimentation. And frankly, even then, our savings rate was not bad, but our capital efficiency was pretty poor.
Those dark days of low growth are behind us. Today, the economy is a lot freer. Savings rates are rising, and the country has a thriving stock market, a competitive industry, and a far more efficient banking system. The financial system today is much more effective in allocating capital to productive uses than was the case 3 decades ago. It wasn't an easy journey. It included big and small changes in policy, and many of them were driven by the Reserve Bank of India. More on that is coming up after the short break. Stay with us. For a decade since its inception in 1935, the Reserve Bank of India was a private shareholders' bank, an instrument of colonial masters. The RBI provided rupee resources freely to the government against sterling assets. Well, sometimes it provided them a little too freely, leading to high inflation. The central bank really came into its own in independent India. The bank was nationalized in 1949 with the enactment of the Banking Regulation Act, which mandated a comprehensive and formal structure of bank regulation and supervision. It was a time when rural India was hundreds of miles away from the banking system. The 60s was amongst the toughest periods. 3 poor monsoons and 2 wars had drained the economy. Essential commodities and services were scarce and expensive. Growth was low and unemployment was rising. All this forced a massive devaluation of the currency in 1966. But the situation kept getting worse. The resultant public anguish led Prime Minister Indira Gandhi to swing to the left. In July 1969, amidst severe opposition, Prime Minister Indira Gandhi nationalized 14 major commercial banks in what is described to be one of the swiftest economic decisions ever made in India. A decision that was accompanied by the resignation of Deputy Prime Minister and Finance Minister Morarji Desai. Soon thereafter, the Congress party would split into two and independent India would be presented with its first full-blown political crisis. Over the next 2 decades, RBI played its part in nation building. Nationalized banks made inroads into rural India. Industry got much needed access to capital, but the finances of the country were far from strong. India's import bill was ballooning. By 1986, India was facing severe strains on its balance of payments. With the rest of the world, imports were rising, exports were on a decline, and state-run businesses had monopolized production. With oil prices spiking during the first Gulf War, foreign exchange reserves dried to a trickle. India was close to bankruptcy in 1991, with a fiscal deficit equal to 12% of GDP and forex reserves of just $1.2 billion, which were just enough for 3 weeks of imports. That's when the country pledged 67 tons of its gold reserves to Bank of England and Bank of America for a $600 million loan. It was in these circumstances that former RBI Governor Manmohan Singh was appointed Finance Minister of the country.
With
the Prime Minister P.V. Narasimha Rao's support, Singh turned the crisis on its head and made it into a perfect opportunity for unshackling the caged tiger.
The world has changed beyond recognition. We in this country have to wake up to the harsh new realities of this world.
That's how India woke up to a new dawn and began the process of opening up to the world. The license permit Raj was dismantled, prohibitive import duties were slashed, foreigners were allowed entry into Indian capital markets, and the economy started to embrace modernity.
The crisis also enabled us to realize that we had to change our ways on various things. One of the things which we introduced was liberalized exchange rate management. That was to, I think, move towards convertibility. And I think that was a decision which was originally thought as risky, but we played it by the ear. And convertibility meant that the market determined rate for the exchange, the rupee, was accepted, and that enabled much freer trade and portfolio investment into the country. And all the present FII inflows and FDI inflows would not have been conceivable if we had not done that.
The RBI didn't leave the rupee to float freely. The market determined the exchange rate, but the central bank intervened to massage volatility and to cool the ardor of speculators whose one-way bets could lead the currency to swing dangerously in either direction.
We made two things absolutely clear and sure, that we are not going to be prisoners of orthodoxy. And for example, there was always this feeling in the market that RBI would intervene at a particular exchange rate, or that we would have a targeted exchange rate, or that we wouldn't allow rupee to depreciate beyond a point. During the day, what we always did, in consultation with our entire foreign exchange management team, was that we would allow it to depreciate. And then the market starts feeling, will it not? So once that happened, then we would start coming into the market in a big way. So in 3-4 days, they all became very conscious that don't do massive risk, because the RBI now had the capacity, and that we will never intervene at the expected point, because there was a lot of speculation that RBI intervening, we would not intervene. Second, that we made no pretense of made no pretense at all that we were using the state bank, we were using some other bank. So nobody knew whether it was RBI or it was the actual requirement of dollars. So they were all guessing. So I think we beat the market in the market game.
By 1997, India had a bold vision for moving toward a fully convertible currency in 3 years. But the external environment turned bleak with the onset of the Asian currency crisis in 1997. The large-scale flight of capital that threatened to cripple the tiger economies of East Asia made Indian policymakers question the wisdom of moving too quickly to a fully convertible capital account.
If you say mid-90s, the IMF believed fully that there should be full capital account convertibility, and it was more or less pushed. With the Asian crisis, there was a pause. At that point of time, this philosophy was introduced, which we also believed in at that point of time. I would say that you must have some preconditions. If preconditions such as fiscal, banking system, etc., if the preconditions are satisfied, then there will be a lot of benefits of full capital account convertibility.
A weak fisc has posed a severe challenge to the RBI, both as a government's debt manager and as a country's monetary policy maker. A landmark move at damage control came in 1994, when RBI Governor Dr. C. Rangarajan got the government to agree to phase out issuance of ad hoc treasury bills. These ad hocs used to clear the pitch for the conduct of independent monetary policy. Their abolition and subsequent replacement with a rule-based Ways and Means advance to accommodate the government's overdraft went a long way in giving the RBI more control over money supply and price stability. By the late 90s, the Indian financial system was moving to completely reform itself. 3 weak public sector banks got a new lease of life. State-run public finance institutions were revamped. The insurance sector was opened up and private sector banking took off in a big way. That isn't all. Prudential norms were adopted to ensure that Indian commercial banks were adequately capitalized and had clean balance sheets. In the first decade of the third millennium, Indian banking was on a roll. ATMs began to supplement branch banking, online transactions slowly gained acceptance, a real-time gross settlement system was put in place. Meanwhile, the interest rate regime turned benign. The rupee was more or less stable and inflation was not too much of a worry. Aggressive private sector banks grew in size and stature, and apart from the one-off incidents, the financial markets were working like a well-oiled machine.
RBI again was one of the earliest institutions, central bankers, to openly focus, articulate and work towards financial stability. The importance of financial stability was also flagged. So in some senses, the Reserve Bank today is in a position to handle the future of the growth and stability with some sense of strength in the banking system and better understanding. And another contribution I would say is pegging the inflation expectations. We don't have inflation targeting in our country. And earlier it used to be inflation is 7, 8, some people used to say high, low, there was no number. And what we tried to do is we tried to put 5%, we created expectations that the moment it crosses 5%, that's something which we don't like. And we would like over the medium term to be in the range of 3% or 4%, consistent with the global trends. I think that, so these are some of the measures which should help.
So just how has the role of the RBI and that of its governors evolved over the past decade?
The whole economy has become more complex and different than was the case in, say, 10 years, even 10 years ago. And that's fortunate for the betterment of India, but that makes the handling of the problem a little more difficult.
The complexity of the task became apparent in September 2008 with the collapse of Lehman Brothers. Immediately, interbank rates shot up in Mumbai. Dollar funding for Indian banks and companies dried up. The real economy started sputtering. By November, the gloom was palpable. Dr. Duveri Subbarao, the present governor, had stepped into the scene just 9 days before Lehman filed for bankruptcy. Just how did he feel in those days of gloom and doom? Dr. Subbarao will answer that question and many more in a short while. Stay with us.